Keys to the Commonwealth, a podcast where we share the real stories of local community members who are using real estate to build personal wealth, along with tips and tricks from professionals across the industry. And now, your host, Landry Fields.
Welcome, everyone, to the Keys to the Commonwealth podcast. My name is Landry. As an insurance advisor, I work each and every day a lot with real estate investors and the professionals that are in this industry, and I'm very excited for today's guest. He is a commercial lender with Republic Bank and has been in the banking industry for 15 years in and around central Kentucky. Born and raised in Dry Ridge, Kentucky, he received his degree from the University of Kentucky and is married to his beautiful bride, Jennifer, who together they have 4 awesome kids, Jackson, Madeline, and twins, William and Jefferson, along with their silver lab, Tuck. I'm very excited to welcome my friend Jeff Ford to the Keys to the Commonwealth studio. Jeff, sir, thanks for coming on the show.
Yeah, thanks, Landry. Thanks for having me.
Yeah, so hop back in the DeLorean like we do with every episode to start us off, and kind of how did you get into the banking world or commercial lending side of things?
Yeah, well, it's interesting. I didn't start out looking to be a banker, but I got into banking in 2007 on the retail side. If you look at banking, you have multiple facets of it. Retail is just going into the branches, talking to the tellers, doing your daily transactions. Did that for a long time, managed a few branches in around central Kentucky. In 2016, the bank I worked for had a commercial lender who had worked there for 41 years, and He retired and left a book of business. And I spoke to my manager about what would that look like to get more involved in the commercial side. And at that time, I thought a market president position would be something down my path. And they recommended I get into commercial lending. And once you get into the commercial side of things, a lot of people find out it's just really enjoyable. And so that's what I've spent my career doing the last five and a half years. And I've really liked working with local businesses.
So what exactly is more of your focus as far as that goes, or what you do there with the commercial side of as far as clientele or investors?
Sure, absolutely. I really look at commercial lending broken down into 3 different aspects.
Yeah.
You could look at, and when people think of commercial lending, they primarily think of real estate. And real estate's broken down into 2 different areas in my world. You've got owner-occupied real estate. Owner-occupied real estate would be if you have an operating company and you're occupying the space that you own. That's owner-occupied.
So if I, as an insurance agency, bought a commercial building and rented half of it to myself, kind of a scenario.
That's right. That's right. And really probably even a little bit more than that you would consider owner-occupied that you would occupy. Then you have non-owner-occupied or an income-producing property. An income-producing property could be 1 to 4 family units. It could be apartment complexes, or it could be commercial real estate, anything that you're making income off of. So I do loans for those types of industries, and then also do operating notes. We call that C&I lending in my world, and that could be anytime you loan directly to an operating company, whether it's a line of credit, equipment loans, that's on the C&I world. And so those are really the 3 different breakdowns of the commercial world.
So talk to me a little bit more about the owner-occupied versus non-occupied, owner-occupied commercial space, and just, what are the differences for you all and what you're looking at versus some of the breakdowns of what qualifies as owner-occupied and so forth?
That's right. And I would qualify that I'm speaking here as an individual, that every bank's going to have a little different view on how they look at properties.
Okay.
Every bank's going to have their own appetite, and every bank's going to underwrite a little differently. But just in general, if you look at owner-occupied property, if you are occupying more than 51% of the real estate, then you are owner-occupied. Now, typically what business owners will do, if you have ABC company that's selling widgets, and then they want to buy the building that they're operating in, or they want to build a new space, they're typically going to open up a separate company, a holding company, to purchase that real estate in.
Yeah.
And that qualifies as owner-occupied because it's the same ownership there. Now, if I'm looking at somebody that has owner-occupied real estate, what I'm looking at is the company itself and how much money it can afford on rent, and how much and that's going to give me a good indication of if they can support buying a new building, expanding, or something to that effect. So if you have somebody that is currently renting and they want to expand out, or they want to purchase something, a good rule of thumb is if they can get into a building similar to what their current rent payments are, they can probably afford or support the debt of buying the space that they occupy.
Gotcha. Okay. And a lot of times, like I said, it would depend on the structure of the company, whether they buy it in the company's name, or like you said, a holding company, or if like you're an S corp like myself, where do they often kind of just create a whole other entity, buy it, so that they could still potentially hold on to that real estate if they were to sell a business or so forth?
That's right, and that's really where the income piece comes in down the road, because oftentimes a company will want to operate separate from their real estate. And that's a great attorney question and a CPA question on to how you structure that specifically.
Right.
But when it's time to sell your business or to hand off your business, oftentimes the business owner will hold on to the real estate, charge rent down the road, and that becomes a retirement source of income for them. They've gotten rid of their company, they sold it off, but they're still able to reap the profits of the real estate down the road.
How's your world changed as far as COVID in the sense of what, is a good investment property on the commercial side to look at, non-owner occupied kind of side of things and so forth?
Well, COVID, obviously everything was impacted by COVID. So if you're looking at an operating company buying its own real estate, we're really looking at the impact that COVID had on that entity. And as I think everything should. So think about
as if it were to happen again.
Correct.
Type of question.
Or even just how it's impacted the past year, couple years, or to your point.
Yeah.
What sectors of the economy are really impacted. So you got to think hospitalities and restaurants were devastated by COVID. Yeah. Now, a lot of government support came out and helped out. But those are things that just in general, if you're looking to expand, those industries they were just hit hard.
Sure.
Other entities were pretty seamless. And if you look at the rental market side, what I would tend to look at is how did they survive COVID? And in Kentucky, by and large, we've seen that there wasn't a whole lot of fall off in people making the rental payments over the past 24 months, or at least that I've seen. But if you're looking at an investor and you're wondering how bad they were impacted, you can look at the vacancies over the past couple of years and see how COVID played a role into that.
Speaking more towards the non-owner occupied side of residential or multiplex, multifamily units, so forth. What goes into that? So if somebody's not in a business sense wanting to rent it out for a commercial use type of scenario, talk more about the underwriting or eligibility, or somebody's wanting to say, hey, I want to buy a duplex or a fourplex or something like that.
Yeah.
What's going into that? What are you looking at? Is how much their personal finances are playing a role in that is, in some respects, that might be different than a typical house mortgage side of things.
Sure, absolutely. And really, cash flow is king when you're looking at income-producing property, in my view. And again, every bank's going to have a different appetite for it. But a good rule of thumb, if you can find a piece of property that you're renting out and you can collect rents of about 1% of the purchase price of the property, you probably have a pretty good rental property on your hands. It's a good investment property. Oftentimes,
you buy it for $100,000, your rent is $1,000.
Yeah, if you can find a ratio like that, that's pretty strong. Now, banks are going to underwrite to their own different metrics and stuff. However, you've got to take into account age of the property, what repairs need to be made. Are you replacing a roof over the next few years? Are you replacing HVAC? If everything is clean and been updated, maybe you can afford to pay more for a property and get less rent on it in the short term because you're not going to have as much capital expenditures to put into it. If it's an older property, you may want that number to be quite a bit lower because you're going to put more money into the property. So you want to look at that. But just in general, if you can get 1% of the purchase price and monthly rent, it's pretty good. And we had talked before the podcast started, a good thing for people to do is if you can find a duplex or multifamily units, oftentimes the more rent that are coming in can support a better debt load. So if you're buying a 1 to 4 family unit and it's $100,000 for a single family, it may be hard to get rents out of, but if you're paying $150,000 for a duplex, you might be able to get $2,000 in rents.
And it seems like, especially COVID and so forth, that the multifamily side of things or apartments have, because of the shortage of houses in some respects, or the shortage of houses for sale, or that are even being built, that those things have definitely become a lot more of a hot commodity or a focus away from necessarily the traditional single-family rental method that had become a lot more popular in the last couple of years, for sure, pre-COVID.
I believe that's right. And really, from my experience, and this is just all anecdotal, but any single-family residence that comes on the market's gone in no time if it's priced properly. Yeah. So unless have an insight to get property before it hits the market, it's really hard to find a good deal in that area. Multifamily units, their values, in my opinion, haven't changed quite as drastically. Apartment complexes, and then also more people are moving into rental spaces because there's a whole generation of people that aren't buying houses right out of college and as they're starting out, maybe like we did 10, 15 years ago. Yeah. So more people are choosing to rent, which is given more.
I think it speaks to I've talked about this before, where it seems like a generation, I guess, fall in the millennial category, just on the cusp of that. Mm-hmm. But how it seems to be more of a transition of experience that there is sought after, especially early on. If they're not starting families as soon, as soon as they maybe used to and so forth. And that seems like a lot more people are in the younger generation are kind of more about experience traveling and so forth before they kind of commit to some of those things like that.
Yep.
So speaking of the financing side here of those things, I guess you can talk to me a little bit more about the different, because obviously you can get creative on the financing side of these things. What we're looking at, I know a buddy of mine who, is trying to work out some different options as far as increasing the value of the property by doing some overhauling of some of the things with the property that he's trying to purchase. And so there's a purchase price, but then there's also kind of like lumping in being able to have some money to, in essence, as part of the financing, to fix up some of the things within it to kind of add value to it, to obviously increase the rents and so forth.
Yeah. So there's a few things there, and I've run into people that are wanting to, maybe they currently own rental property and they're cashing out in order to make improvements so they can raise their rents. And really what I'm looking at, just as an individual trying to advise somebody, if you're borrowing money, hopefully you're doing so you can increase your rents, you can increase your profits. You can't borrow your way into profitability, so you want to make sure that if you're putting money into it in the form of a loan, that you're going to be able to get out a much better return for that. On the financing side, the bank's going to look at, or any bank is going to look at, a loan to value and a loan to cost. And a loan to cost is really how much you're paying for the property plus improvements. And so if you're constructing it, or if you're buying it, putting renovations into it, a lot of times that can go in. So if you know your lender well enough, those are great conversations to have before you go down the road. But I also like to speak to, as far as how you finance things, or a little. Like you said, you can get a little creative with it. You had a guy on a few weeks ago, Chase, that talked on the mortgage side.
Yeah.
And a lot of people getting into rental property will go and do a conventional mortgage for their first rental property. And oftentimes that's fine. But whenever you're looking at a commercial loan, one thing you're doing is you're separating it from your personal name. And with investment property, oftentimes that's really important, especially for somebody that wants to build a portfolio. You're building up multiple properties in your portfolio.
Yeah.
You want to get all of those out of your personal name. Or if you're going with a friend or somebody else, a business partner, you both don't want to have those tied to your personal credit.
Sure.
And oftentimes I've seen people will try to put rental property in what's considered a secondary market loan in their personal name, and then it drags down their personal credit. If you put it into a business loan, the business is taking out the loan. Yeah. It's the one responsible for the payments. Now, you're still going to have to guarantee it, and you're still going to be on the hook for it, but your personal credit isn't at risk at that point.
And I think something I've seen there, it seems like it's hard. It seems like obviously the first dipping of your toe into real estate and buying short-term rental, long-term rental, commercial properties, etc. Obviously, you have nothing to stand on as far as a history goes. So it's obviously, is it true from a banking side? It seems that you're kind of underwritten or looked at through a little bit of a closer microscope in some respects. Then that kind of maybe gets easier down the road in some ways.
Yeah, that's probably accurate. I think, again, each bank's going to be different, but if you can take a piece of property to a bank that has a current lease, if you buy something that's currently rented, it becomes easier. One thing I should say about when you're looking at rental property, at least me personally, I'm looking to see, does that property, the income off of it, support any debt that you're taking off of it, and then is able to turn a profit.
Yeah.
It's not good enough always for somebody to have a good global income to then go buy a piece of rental property. And sometimes that can work if you're just starting out. But when you're buying investment property, the goal of it is to make more money.
Yeah.
So you want that individual piece of property to stand on anything that's financing it.
So let's break that down if we can for a little second. Because what is the term? I think DSCR or
debt service coverage ratio.
Yeah. So talk to me a little bit about that. Somebody's looking at it. They're trying to break this down in a number side of things on DSCR.
Yeah.
What that really means, what numbers are being factored into that and so forth.
That's right. So what I look at, I actually have a really good friend of mine who's wanting to buy a piece of property right now, and we talk all the time. Just in general, if something's a good deal, you want to see how much is your loan going to be. Mm-hmm. You take that
from overall or monthly.
Well, either way. Okay. So, monthly payments. Yeah. So you can break it down monthly payments or annual payments. A lot of times I'm looking at annual payments because I'm sitting with an insurance agent and you pay you a check once a year. So you can break it down either way, but you want to have your total rents, and then you want to be able to subtract out your loan payment or divide that out. And if you can come up with a pretty decent DSCR, which we would consider, say 20% expenses would be one thing we would look at. So you have 1,000 months rent. Mm-hmm. You're able to take out 20% in just random expensive, which could be insurance, property taxes, so on and so forth.
Yeah.
What's that debt service coverage ratio going to be? And then look at it at 30%, look at it for 40%. Now, if you have a borrower who has lots of rental properties, you can look at how their portfolio is performing, and you can see how do they operate. Do they operate on a 1.2, a 1.3, 1.4? Or I'm sorry, at 20%, 30%, 40%. Yeah. But if they're just starting out, you've got to kind of assume the worst. And that's when I was talking to my friend. I said, well, you don't really know how much repairs are going to be, maintenance costs are going to be, and stuff like that. So you want to veer on the side of being really conservative. The other thing to look at is if you have 1 to 4 family units or apartment complexes, you as the owner are on the hook a lot more for those expenses than if you owned a piece of commercial property, a warehouse. A lot of times people will put a triple net lease in place where the person renting is responsible for the taxes, the insurance, and a lot of the maintenance and repairs.
Okay.
And that leaves the investor pretty much hands off. Well, if you're an investor looking for commercial property, you can get a lot thinner on those margins than just going and buying a family unit.
Yeah.
If that makes sense.
Yeah, it does. So, I mean, it'd be interesting, especially if somebody was trying to grow a portfolio of, trying to get into multiple options. What kind of advice would you have in that sense as far as, like, I'm a person, I don't have investments, or maybe I have one, but I wanted to start to grow this thing out, Right. What are some of those advices if somebody was sitting down with you to kind of a plan of action, so to speak, in those regards?
Yep. I think a good first step, a lot of times people that are getting into rental property, they're in their own house. And so a lot of times the person will use their line of credit, and we've done this in the past, to purchase a rental property. If you can find one small enough, and again, right now it's tough with the market, but if you can find the right one, put a tenant in there, fairly low risk. At any time you're dealing with investments, there's always a risk. Rental property is a risk. Anything could happen there. However, it's been shown to be a pretty safe investment. But if you can find one, pay cash for it, use a line of credit, maybe get some financing through the bank with it, and then let that perform for a little while, and then use your profits from that to purchase your second one. Be careful about leveraging your properties too much. Okay. And you'll do that sometimes, but you want to be so here's what I mean. Let's say if you bought a house for $100,000 and you borrowed 80% of it. You paid that down to 60%. Mm-hmm. So you have a $60,000 loan and a $100,000 piece of property.
$40,000 equity.
You have $40,000 worth of straight equity, but probably $20,000 worth of equity that you could use for another property. Then you pull money off of that to do your down payment on the next one. Then you do the
refining it kind of a scenario.
Correct. And then if you do that enough times, you've got a whole portfolio that's highly leveraged. Well, if the market turns, now you're really at risk.
Yeah.
And that's what I say, if you can pay off your loans, if you can pay down more sooner rather than later, and you have properties free and clear, then that's just straight income.
Sure.
So leveraging debt is fine to an extent, but like I said, it's a risk. Just be careful with it.
Yeah. It can be risky, and that's where a lot of people ran into problems back in turn of 2008, 2009, I assume, like over-leveraged in that as far as their properties, exactly what you're talking about there.
That's right. And there was, in 2008, there were artificially inflated appraisals and all kinds of stuff that went into that. But at the same time, nobody can see the future. Sure. I believe in rental property. It's a good investment, but you just don't know. So the less leveraged you are, the better off you are.
And from the banking side of things, talk about that a little bit, as I definitely see that question or hear that question a lot, especially in the current market. I think a lot of people believe it's not going to crash like 2008 because of reasons I want you to kind of like go into from the over-leveraging banking side of things, that there really is a true demand from lack of new real estate being built, a demand of homes, people wanting to buy homes, at their credit history, I assume, is part of that, where there's a lot more people with better credit than there was back at that point in time too, from what I've heard and so forth. So talk to me about differences of why it's different today than it was back then at that point. Back then being only like 12, 15 years ago.
Sure. Well, my personal opinion is, like I alluded to, the 2008 crash was artificially inflated prices. A lot of $1 million homes were built here in Lexington that were not $1 million homes. And then when people went to refinance them, they appraised for $750,000, $800,000. That's probably what they should have been worth on the front end. You fast forward to today, a lot of the problems that happened in 2008, 2009 have been remedied, and now it feels more like a supply-demand issue. And I think you had Josh on the podcast a while back who probably could speak to it, that there's just not as much to draw off from, and so that's going to drive the prices up.
Yeah.
That's not artificial. So I don't know what's going to cause the prices to come back down. They could. One thing I think of is interest rates going up, and they're going up across the board. And we have not had a high interest rate market since 2007. It's been a low interest rate market for over a decade.
And what was considered a high interest rate market at that point?
Well, I was just starting into banking, but I remember we bought our first house in 2008. I got married, and rates at the time were hovering around 6% for just a secondary market loan.
Okay.
One day they crashed from 6% to 4.5%, and I called my future wife, and I said, "Hey, we got to buy a house," and because rates were that volatile at the time, and really since that time we haven't seen anything in the sixes for over a decade.
Yeah.
But historically speaking, 6% is not a terrible rate.
Right.
But right now, rates we've been really programmed to like rates in the fours, rates in the threes. The rates got into the twos last year, and it's
now everybody expects that should be the norm, and you're like, that's not even really healthy. I'm sure you would.
Right. And before COVID, rates were going up at a pretty good rate. Not extreme, but they were going up, and then when the world stopped, rates went back down to nothing. Now you worry about inflation. And so one of the ways that they can offset inflation is trying to raise the interest rates to keep prices down. But then, again, this is just my opinion, that so much of our properties and our real estate, the prices of them are there because people can afford them with today's interest rates. If rates go up too much, is that going to cause the price of real estate to go down? And it's just hard to it's hard to know.
I think historically Kentucky was, in a big way, kind of protected from the true crash of 2008 as far as, not that we were in a protective bubble, so to speak, but it was definitely a lot different than it was in a lot of other areys. So, if that was the case here, I'd definitely maybe a plateau or maybe a slight dip. But, it's a very strong market in Kentucky with a lot of people moving here, especially a lot of my home purchaser clients, moving to the area. That it definitely seems like it's a place that's drawing more and more of a draw for people moving from out of state to Kentucky, which is probably only going to help that. And
I would agree with that.
Do you have any investment property yourself?
No, we actually sold off our investment property last year, but going to that ratio that I looked at, the price of it was such that it just made sense to sell it. And I know the person that bought it couldn't couldn't charge enough rent to pay for it, and we sold to somebody that used it as a family residence. Okay. So we did that, and we'll get back into it. But I've had a couple pieces over the years, and I've invested some using a line of credit. Went with some buddies of mine that we just put some cash into a deal and worked it that way.
And speaking of which, that's probably also a big portion of what's driving the market too. I would say that not to gloss over that too quickly, and that the line of credit is a great asset to be able to be used. And because of the rapid growth of said property value, all of a sudden a lot of people like myself, et cetera, have a large amount of equity that they did not have just 2 years ago in their property, and are probably wanting to try to utilize that and put that to use, like I'm trying to do myself, type of thing. So that's probably also a big factor in driving that.
It is, and I would say, just as if I were giving advice to somebody, people are seeing a lot more equity than what they realize. And I talk to people all the time that they're not aware of how much value their house has gone up.
Oh, yeah.
And so if you're sitting on a lot more equity than you're used to, it's really tempting to take that and go buy a rental property, which is great. It's a great investment. You can also, when you purchase something on a line of credit, it's a variable. And so you're exposing yourself to interest rate risk. And that's when you can go to your commercial lender and say, okay, now I've bought this piece of property on my line of credit. Can I refinance this onto some sort of a rate that'll give me a fixed payment over so many years? Most people listening to this podcast have probably dabbled a little bit with commercial loans. Most of your commercial loans aren't going to be fixed rate the entire length of the loan. Yeah. You may fix a rate for 5 years, for 10 years, or something to that effect, but that's still a lot better than having something that could vary month to month.
Right.
And if rates start to go up, and you've got a 4% line of credit that you bought rental property off of, but then in a year it's at 6%, that could be really impactful for your cash flow on that piece of property. But then also it gets back to the philosophy of, if you've got a rental property that you can't get enough rent off of to finance it, is it really good of a deal? So go into it looking at the rents that you can collect. If I were to stretch this out over 20 years, can I afford that payment?
Gotcha.
And to that point too, when I'm talking to anybody about rental property, 20 years in my mind is a really good amortization to think, is this a good deal? If you've got to stretch it out to 25 or 30, you may really want to consider, is this the best rental property?
Gotcha.
Because, a couple things with the 20-year amortization, you're going to pay it off quicker. Your balance sheet's going to look better. That's a good thing.
Yeah.
But two, it's just, if you're stretching out to 25 or 30 years, it takes you so long to pay that principal down. Yeah, you might be making money today, but then when you go to sell it, or if there's a correction in the market, you can get upside down a lot quicker. So think about a 20-year amortization, in my mind, is a really good thing to keep in your mind on, is this property worth doing?
Gotcha. And I guess the banks can fluctuate with what, options in that respect. Like you could offer, and sometimes it can come down to the client and what they want to do, whether it's a 20 or 25 or something like that sometimes, right?
Yeah, and I've seen people too, they'll want a higher amortization. Some people will come out, some people want a 10 or 15 year, especially if people are paying on it for a long time, or if they're buying a piece of property that they just want to own it free and clear. Oftentimes people make extra payments towards their rental properties, and that's great too.
And that's why the commercial side, especially the local bank type of thing where you are, is so valuable as an investor. Those relationships, like you said, you're kind of building relationships in those portfolios for yourself, but how valuable that can be, it's have someone that's kind of for you and in your back pocket kind of a thing to utilize, and there to they want you to succeed as well, and hopefully there to help guide you in a safe way of doing that.
Yeah, I think so. And I've always learned it's better to work with your lender, your banker, before you make any decisions than to make a decision and then come talk to your banker, because we can help give advice. Yeah. We can help, through that process. And sometimes once you get into it, it's a little too late.
Yeah, I would say the same thing a lot of times with insurance.
Absolutely.
To invest. Anything as far as commercial, and there's definitely different aspects of insurance with that. I mean, what do you all usually?
Well, yeah, and I was thinking about that driving over here. Obviously, I've known you for a while now, and on the insurance side, any loan I do, whether it's real estate, investment property, or even non-real estate, every loan that I could possibly do has some sort of insurance component.
Yeah.
So if you're a business owner, you're looking to do any sort of lending, whether it's real estate, whether it's a line of credit or equipment loan, you got to have, you got to have insurance on it. That's a great time for people to look at their insurance. And one of the things that we're looking for on a P&L is how can you mitigate expenses? And sometimes insurance is a little higher.
Profit loss.
Yes.
There's a lot of acronyms in banking and insurance for sure.
That's right. So it's a great time to have your stuff reviewed.
Yeah.
If you have an insurance agent, in my opinion, when you're buying a piece of property, a rental property, or you're doing a business venture, go shop it around.
That's why I always suggest at least a broker type of thing as well. Because, we're not, I'm not pigeonholed into one specific type of product or brand or company type of thing. We can advise on the best option and present the best option for sure in that respect. And the cool thing people don't realize sometimes know as well is using the value, which I think would be it's a different conversation entirely, but the value of being able to leverage and use life insurance as a form of part of that leverage, or banks utilize that a lot as far as what I'm getting at as far as using life insurance in that respect.
Not as much in real estate, but in deals where you're loaning to an operating company where you have a person where the individual is really important to the success of the company, life insurance is key. And there are certain loans that we do that require life insurance to be held on behalf of a key employee.
What are your professional or personal goals that you're kind of looking at for 2022?
For professional goals, I want to produce $10 million in business loans this year.
Okay.
Like I said, I spread that all across different areas of lending. I've been in commercial lending for 5 years now. I've got a pretty good base of people that call on me, and I still do a lot of knocking on doors because that's enjoyable. But that's kind of how I measure to see how well things are going.
What are you all watching on TV lately?
We've been in a bit of a lull. But here lately, a lot of the Disney Plus stuff, with the 4 kids, there's always right. And so
I'm in the kids, like the princess side of things still right now.
That's fun too, though.
It is.
It is. It gets So, but all the Disney Plus shows have been enjoyable. We've watched, the Marvel shows, the Star Wars shows. We're behind on Boba Fett, but we need to catch up on it.
What's the first or favorite concert you attended?
Yeah, it's funny. I had to think about that. So. This is really random. I'm from a small town, so it's either Neil McCoy or Johnny Paycheck, and many people probably won't know what either of those people are.
Yeah, I sadly do not.
So Johnny Paycheck is the guy that wrote this or sung the song "Take This Job and Shove It," which everybody's heard.
Okay, yeah.
So he may have been my first, or Neil McCoy. Neil McCoy sang "The Shake."
Yeah,
it's terrible.
Favorite trip that you've been on or want to go on?
I would love to take my wife to Hawaii. That's something, and with our stage of life with the kids, it's hard to get away at that age. But, when the kids get a little bit older, that's something we're going to do, and maybe spend a couple weeks out there. You got to take a couple days for the time change to take effect. And so that's on the horizon down the road sometime.
Nice. That'd be great. I definitely want to take a trip out there at some point. What's your favorite local date night spot?
We've been going to, Merrick Inn is our go-to place.
Okay.
It's not too far from our house, and it's just I love the environment there. And
so, as I've said before on this podcast, I still need to get there. I somehow have never been there.
It's great. It's good. It's a good. I mean, you go there. Don't get the steak. The steak's fine, but everything else they have on there is excellent. So there's a pork dish I get there, and then my wife gets a chicken dish.
Okay.
That it's great.
First car you owned?
It was a 1991 Eagle Talon 4-cylinder with turbo.
I don't know if I even know what that is.
It was like a Mitsubishi Eclipse. It was ugly as could be. It was white with a black top on it.
Okay.
I think I had it for 9 months, then I sold it and bought a truck.
Okay.
Yeah.
Gotcha. And, I mean, as far as Kentucky, what's your favorite thing about Kentucky? Born and raised? I mean, there's a lot to offer. I appreciate it more the older I get. What about yourself?
Yeah, I really enjoy. I've been in Lexington for 20 years. I came here in 2000 from a small town, still, identify with being back home. But I feel like I'm from Lexington almost at this point.
Yeah.
Because I've been here for, 22 years now. And being in the hometown of the place where you graduated is a lot of fun. We go to all the UK football games, go to as many basketball games as we can. And I think just the UK football tradition and what it's becoming, and then having my kids being able to join in on that is a lot of fun.
Yeah.
So I'd say for...
Keyword becoming, because a lot of people would be like, what tradition is football? No, I love football. Yeah. I honestly, if I was to have a choice between season tickets, even though I'm a diehard basketball fan, the experience, and I was in college there from there, and that whole 06, 07 run, and some of this, I was like, it's so much more of an interest. I don't know. I just love it a lot. The Avery game is so much more. Is so much bigger. And
well, here's a question for you: would you take a UK SEC football title or a basketball national championship?
Right now, a football title.
I think I would too. For sure.
Yeah, 100%.
Yeah,
I think that goes a lot further in recruiting, the school, et cetera, type of thing. So, last parting words, where people can kind of get in touch with you if they got commercial lending needs or questions and so forth.
Well, I'll give my email address. You can shoot me an email, or, if you know Landry, contact him. But my email is jford@republicbank.com. Like I said, I'd be more than willing to answer any questions you have or just give you some advice.
Jeff, appreciate you coming on the show today, and thanks for listening. Make sure you subscribe to the podcast, and we look forward to having everyone join us next week for another awesome episode of the Keys to the Commonwealth podcast. Jeff, thanks a lot.
All right, thank you, Landry.
To learn more about this podcast, visit our page at keystothecommonwealth.com. To connect with Landry regarding insuring your investment portfolio, email landry@novainsuranceGroup.com or call 859-687-2004.